Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We're heading into earnings season on the ASX, the time when companies report profits and perhaps more importantly, let the market know what they think is going to happen. Today, I wanted to get an idea of what to expect, the trends in companies we should be keeping an eye on. The Australian Foundation Investment Company, AFIC, is Australia's oldest and largest listed investment company specialising in Australian equities. It reported last week, a drop in profit, but that was mostly thanks to a mega dividend from BHP 12 months ago. Remember, this is general information only. You should seek professional advice before making any investment decisions. Mark Freeman is the Managing Director of the Australian Foundation Investment Company. Mark, welcome to Fear and Greed.
Yeah, thanks for having me.
Just before we jump into it, can you give us a 101 on listed investment companies and exactly what you guys do and how you invest?
Sure. I guess the difference between a listed investment company and a managed fund is, given the name, we are like managed funds, but we're in a company structure rather than a trust structure. And being in a company structure, we then are listed on the stock market. We put out monthly updates that says what is essentially fair value for the portfolio. We call that an NTA. And I guess we said it's an advantage of having a portfolio within a company structure is that we've got a limited number of shares on issue. So we don't have funds flowing in and out of our company on a regular basis, which requires us to keep buying or selling. We've got a fixed capital base. And so we can essentially control how we manage the portfolio and are not forced to transact based on whether money is coming in or out of the company. We do pay tax, so we are a tax-aware investor. I guess that puts us into a similar position that most retail investors are. As many people may or may not understand, managed funds tend to see themselves or measure their performance pre-tax and give you performance numbers on that base. Ours are actually post-tax, so we are aware that taxes can be a considerable drag on the performance, but that's included in the way we run the funds. Being a company structure, we have a board of directors, a group of people who are all experienced business people, often sitting on a number of boards. They provide oversight in terms of the company, so investors can take comfort that there is a group of people that oversee what we do. We have an investment committee that oversee how we manage the portfolios. There's transparency from coming with a listed company. You can see our financial accounts. We make ourselves available at AGMs and shareholder briefings. You can see what we do. You can interrogate us. We make ourselves accountable. And we tend to be long-term investors. And so we're trying to find quality companies that we can truly hold the long term. And we understand the importance of paying out franked dividends to our investors. So that's a bit of an overview.
Okay, so some of your big holdings are companies that we'd all know, BHP, Commonwealth Bank, CSL, Macquarie, Transurban. Just your results very much reflect how those companies perform. So the net profit last week of $310 million, which was down a bit, 14%, that was, I think, in part because of the special div that BHP paid out. But am I right basically saying if the companies that you're holding do well, you tend to do well, as does your share price?
Yeah, that's right. We're sort of essentially a conduit between the investments that we hold and our end investors. And I think the other thing I didn't put out earlier is the cost to run. AFIC is around 0.14% with no performance fees. So it's a very low cost to run it. Shareholders own the company. We're accountable to the shareholders. So therefore, given that very low cost to run the business, as you said, it means the performance we get out of our investments flow through to our end shareholders.
Okay. So with all that in mind, we've got earnings season kicking off properly this week. We had a few last week, but basically things heat up during the middle of this week and beyond. What are the key themes that you'll see during reporting season?
Yeah, well, look, going into any reporting season, everyone's trying to predict how the market will go. I guess one of the factors I think about, though, is where's the market at going into that reporting season? So if the market is very high or has had a very high run, it's quite likely that whatever companies produce will probably disappoint the market. If the market's at a very low level, once again, company results will more likely provide a movement upwards. So, there's the results the companies produce. It's where the market is. But in particular, it's the outlook comments that companies make. And particularly going into this year, I think most market participants have been surprised at how well equity markets have held up here and globally. It's fair to say that going back 3 or 4, 5 months, everyone was expecting the economy to really tail off with rising interest rates. Everyone was expecting a fair bit of pressure to come on the economy. And certainly there are areas that are under that pressure, but broadly company profits have held up pretty well. The US economy seems to have held up pretty well. And so we go into this period and probably results will broadly be reasonable. So I think then what people will be saying, well, how are you seeing the next 6 months? Are you starting to see finally some signs of a slowdown occurring with customers? And when you talk about the resource part of the market, that's very leveraged to what China may or may not be doing.
Stay with me, Mark. We'll be back in a minute. I'm speaking to Mark Freeman, Managing Director of the Australian Foundation Investment Company. So let's take resources and the big miners in particular. What do you expect to hear from them over the next couple of weeks, given what's playing out in China and the uncertainty around stimulus? Having said that, last week they did come out and say they're trying to help the property market, which will help commodities, but consumers are still seemingly not a lot around for them at the moment. How do you think what will the BHPs and that be talking about?
Look, I think certainly they'll have healthy balance sheets. I think they'll probably talk about the cash flow and dividends they're producing. And the big resource companies, the BHP and Rio, they have become important sources of franked dividends to Australian investors. And I think the model those companies have at the moment is to keep themselves financially strong and get dividends to shareholders, which we appreciate and applaud. And I think everyone want to know what they're seeing out of China. And as you said, the stimulus that comes out of China, I think there had been an expectation that perhaps they would start to pull that back a bit. They want to see their economy more driven by a consumer-led approach rather than constantly having to do capital investments. But, once again, it sounds like that sort of stimulus may continue, which gets resource stocks running in the short term. So I think that'll be a discussion about where they see China and its policies.
Among the big four banks, only Commonwealth Bank reports in the next few weeks. Macquarie Group also reports. But with Commonwealth Bank particularly, is it that ongoing story of profit margins, as in net interest margins?
Yeah, well, that's the focus. And probably increasingly, though, everyone's watching what's happening with the bad debts. Are they rising? They've been incredibly low for a number of years now, and most people would say probably unsustainable. So, everyone's expecting them to creep up a bit.
Yeah.
But I think compared to perhaps where we were in the past is the capital that banks have to hold now is far greater than it ever used to be. So they are in a financially stronger position. All the four banks have, focused their businesses. They've sold off what you'd call sort of non-core assets and got back to core banking activities. They're more sustainable payout ratios, so the dividends can be a bit more reliable. So, in this environment, the dividends and the franked dividends they pay out, we're pretty comfortable with. And I think the part the market often misses with the banks is perhaps an underappreciation of the value of the franking credits, and we certainly value that. We've been nibbling a little bit at NAB as it dipped because we look for sort of what we'd call temporary bad news in the stock. It tends to provide the best buying opportunities. So we have a list of companies that pass our quality criteria. Then it's often bad news that sort of invites us to add more. With the banks, you sort of had a double whammy between rates going up, but also there was obviously a lot of issues with the US banks recently. A few of the regional banks went under. That caused a lot of nervousness in our banks. They got sold off quite a lot, and we were starting to see some value. So NAB, for example, got to a yield of around 6%. When you add franking to that, you're getting something close to 9% yield.
Yeah.
And that's when we start seeing some value in the banks.
What about another one I want to mention when you talk about seeing value is CSL. You hold CSL. It has been kind of a darling of the market until about the middle of last month, and it's come off about 15% there on some misses. What do you expect from CSL this reporting season?
Yeah, well, look, it's I guess it goes to these same patterns where the market, I think, was a little bit of ahead of itself in terms of the profit forecast. There's still an ongoing recovery from sort of the COVID period coming through and sort of downgrading a profit forecast. The market doesn't like it. So, and it was on a probably, I would say, a fairly full valuation, PE multiples in the low 30s, but it's had quite a significant pullback now. So it's back to more what I would call sort of longer term multiples. So I'd say it's probably, to us, it's a very fair price for this stock now. And there's still lots of projects they've got in play. There's still some quite significant products that are going through trials. One in particular, the market is quite excited by, which is a product they've been working on for a number of years that, again, it's an outcome of their plasma product that they extract. They utilize components within plasma to produce the products that they do, but then a lot of it's wasted, and they do a lot of research on the wasted product, and they're working on a product that if you suffer a stroke, you take this product and it'll help clear the arteries. But look, when you're in trials, these are very high risk, but I'm really trying to do that to illustrate that there are a number of projects the company's working on that will take shape over a long period of time. But there's temporary weakness in the share price because I really think because markets' expectations on profit growth were too high. They've really come back to much more reasonable levels, and the stock's come back to a much fairer price.
Mark, thank you for talking to Fear and Greed.
Pleasure, anytime.
That was Mark Freeman, Managing Director of the Australian Foundation Investment Company. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.